we are going to start some of the questions of dividend policy. This is question number C7.1. Now all the questions which are asked in examinations are easy, but there is no single question of Modi, Giuliani, Miller. So we will be taking one oral question of Modi, Giuliani, Miller. But first let us solve the questions which are normally actually asked in examinations, and the categories are very easy. C7.1. Following information relating to JEE Limited are given. Profit after tax is 10 lakhs. Dividend payout ratio is 50%. Number of equity shares is 50,000. Cost of equity is 10%. Rate of return on investment, this is nothing but R. Cost of equity is nothing but KE. What would be the market value per share as per Walter model? Now, if I want to find out EPS, earning per share, I can do this. Profit after tax divided by number of shares. Actually, sir, it is earnings available to equity shareholders divided by N. Agreed. But when there is no preference dividend, or profit after tax is nothing but earnings available to equity shareholders. So I can do PAT divided by N. PAT is given, profit after tax is 10 lakhs. Number of equity shares is 50,000. It is 20 rupees. This is E1 or EPS1. Dividend payout ratio is 50%. So D1 will be 20 into 50%. That is 10 rupees. Cost of equity and are available. What would be the market value per share as per Walter's model? What does Walter model says? Your market value per share is D1 plus R upon KE, E1 minus D1 upon KE. This is what Walter have suggested. Sir, Walter have suggested 0%, 100%. No. What they are asking is, if we decide to distribute 50% of dividend, what will be market price of the share post dividend as per Walter model? And this will be market price. D1 is 10 rupees plus R is 0.12 divided by 0.10. E1 is 20 minus 10 upon 0.10. The answer will be 20 minus 10 is 10 multiplied by 0.12 divided by 0.10 plus 10 divided by 0.10, which is 220 rupees. So if company is planning to declare 50% dividend, the market price of the share post dividend as per Walter model will be 220. This is my first answer. What is the optimum dividend payout ratio according to Walter's model? This is my second answer. Walter says if R is greater than KE, which is the situation over here because 12% is greater than 10%. Walter suggests you should declare 0% dividend. This is our suggestion. What is the optimum dividend payout ratio according to Walter model? It is 0%. If R is greater than KE, nothing should be distributed to shareholders because company is earning more than shareholders. And market value of equity shares at that payout ratio. So what will be market value of equity shares if the dividend payout ratio is 0%? Will be P0 D1 plus R upon KE, E1 minus D1 upon KE. D1 will be 0, 0.12 divided by 0.10. E1 minus D1 will be 20 minus 0 will be 20 divided by 0.10. It will always be higher than this figure, right? Because this is not at optimal dividend policy as per Walter model. So this figure will be higher. This will be 20 into 0.12 divided by 0.10 divided by 0.10. It is 240 rupees. So as per Walter model, 0% dividend is optimal payout ratio, and at 0% dividend, the post dividend market price of the share will be rupees 240. What is good in the question? Nothing. It is absolutely easy. If you know Walter model, you can easily solve it.